5 parts of your credit report and why they matter to you. Hi all, today we're talking about credit reports and what makes up your score and why you should care. Now the caring part is easy. Nobody wants to spend hundreds of dollars more each month than they need to, and by caring about your credit you can put that money to better use. Now for me, the realization came when I bought my last car. 12.99% interest caused my note to be almost $200 more than if I'd have had great credit. Add to this, insurance is based on credit as well as any other loans, and I could easily be paying $400 more each month because I did not know how to play the game. Now what would you do if you had great credit and an extra $400 each month in your pocket? I know what I'd do. Now, credit is easy. My mom said so. All you do is pay your bills on time. That's it. Wrong. Your credit score is made up of over 5,000 different parts, but it breaks down into just 5 for us. Payment history makes up 35% of your score, and it is as simple as just paying on time. Amount owed, or utilization, makes up about 30% of your score. It is a little more tricky, and this is based on percent of available credit and how much you use. Now, for instance, if you have a $100 credit card, a credit card with a max of $100 value, and you owe $40, you would have a credit utilization of 40%. Now this is considered a bad thing, as you really want that to be below 30%. We'll get more into this in future videos. Length of history. How old is your file? What is the average age of your open accounts, and what is the oldest account? This is just an outline of this category, and it does make up 15% of your score. Types of credit, or your credit mix, makes up about 10% of your score. Now this is revolving, like credit cards, and installment loans such as a car loan, and that is the basis of this particular category. New credit makes up 10% with inquiries, and new loans or credit cards makes up the final 10%. Now that we've gone over an overview of what makes up your credit score, we're going to go into a little detail about the first 2 categories, specifically what is payment history and what is your utilization. Those 2 make up 65% of your score, and we really need to dig deep into what those 2 represent. Now, starting with payment history. Payment history shows how you paid your accounts over the length of your credit. Now, this evidence of repayment is the primary reason why payment history makes up 35% of your credit score, and why it's such a major factor in its calculation. Now, research does show that your track record of payment tends to be the strongest predictor of the likelihood that you'll pay all your debts as agreed, and as you can imagine, a lender's #1 priority is your past record of paying back or not your loans. Now, a few late payments are not an automatic score killer. An overall good credit history can outweigh 1 or 2 instances of late credit card payments. However, having no late payments in your credit report does not mean you'll get a perfect score, as payment history is only 35% of the whole score. Now, the types of accounts that are considered for credit payment history include credit cards, Visa, MasterCard, American Express, Discover, etc. Retail accounts, such as credit cards from stores like the Lowe's credit card, department store credit cards, those types of things. It also takes into account installment loans, where you make a regular payment every single month, such as a car note or a mortgage. Finance companies' accounts, and of course, as I just mentioned, mortgage loans. Now, public record and collection items also fall into this category. These types of events are considered quite serious Although older items and items with small amounts will count less than recent items or those with larger amounts. Negative factors would include bankruptcies, lawsuits, and wage garnishments. Now, 7 components that make up your payment history. Payment information on credit cards, retail accounts, installment loans, mortgages, and other types of accounts. How overdue or delinquent your payments are today or may have been in the past. The amount of money you still owe on delinquent accounts or collection items, and the number of past due items on a credit report. The amount of time that has passed since the last delinquency, adverse public record, or collection items were introduced, and the number of accounts that are being paid as agreed. Now, all of these are parts of what affects your credit score. Now, some tips to enhance your payment history. Make sure to pay your bills on time. I know it sounds simple, but reality is it's the simplest thing you can do. Set up auto payment on your credit cards for the minimum payment. Make sure all your bills are paid on time. Get current or stay current on any missed payments or older credit problems. It counts less towards your credit score, so the longer you pay your bills on time, even after having a late payment, the more potential your FICO score will increase. Contact your creditors. Sometimes they're willing to push a payment, and that way you won't be late. Communication is the key. Now, payment history is the biggest score factor, so it is important to pay close attention to it and make sure your bills are paid on time. The next section is the easiest 30% for us to control. It is the amounts owed, and in very general sense, amount owed refers to how much debt you carry in total. However, the amount of debt you carry is not quite as significant as the credit utilization. You'll hear people talk about credit utilization all the time. That is a percentage of a person's available credit. When it is being used, and it can indicate a person is overextended and is more likely to make a late or missed payment. Now, accounts owed on Now, research has found that your level of debt is predictive of future credit performance because the amount owed typically impacts your ability to pay all monthly credit obligations on time. Now, not to worry if you have debt. It doesn't automatically make you a high-risk borrower. However, as your balance increases percentage-wise, so does the probability of difficulty meeting monthly payments on time, but that's just what determines your credit score. Now, part of the science of scoring is determining how much is too much for a given credit profile. There are 5 factors that the amounts owed category looks at. It looks at the amount owed on different types of accounts, be it revolving, such as credit card, or installment loan, such as your car or home mortgage. How many of your accounts have balances? Do you have 5 credit cards? All of them carry a balance, or do you have 5 credit cards with only 1 carrying a balance? If all of them have a balance, it is an indicator of a higher risk level. Credit utilization ratio on revolving accounts. Your credit utilization ratio on revolving accounts is the percentage of your available credit that you're using and is an important factor in your FICO scoring. High percentage of available credit means you're close to maxing out all your credit cards, which can have a negative impact on your FICO score. On the other hand, having a low percentage of available credit can have a positive impact. In some cases, a low credit utilization ratio will have a more positive impact on your score than not using any of your available credit. That's why I occasionally take my card, whip it out, put a gallon of gas in it, put it up, whip out the next one, put another gallon of gas in it. let it show just a little bit. It shows that you're using the card, but you're not abusing the card. The last thing it looks at is installment loans. How much you owe compared to the full debt. For example, if you borrowed $10,000 to buy a new car and you paid back $2,000, you still owe about 80% of the original loan value. Now, paying down installment loans is a good sign that you're able and willing to manage and repay debt. The amount of debt that you owe is an important part of your credit and makes up about 30% of your FICO score. Make sure to keep track of your debt and card utilization. Now, this information was all gathered from myfico.com. I want to thank the guys out there for putting it together for us. And I hope I've helped bring a little bit more information into your life about why it's important to keep your credit in good standing. This basically brings us to a conclusion. We have gone over the 5 parts of your credit score, why it's important to have a good credit score. We went over in depth payment history and account owed utilization. We're going to go over the following 3 categories: length of history, types of credit, and new cards on our next video. Make sure to like and subscribe to watch those videos as soon as they come out. And if you see a link right up here, whoops, if you see a link right up there, you'll know they're out. Guys, until next time, I'm out.